Yes, we are back, my friend. You know what that means. Time for a little bit more Tasty Live with this. Let me explain. Chris Vecchio, welcome. And happy 2024 to you.
Tony, we're past the first 3 days of the year. You can't say that.
Well played. Well played, Chris. Well played. I'm a team player. I don't know about the other guy over there.
No, you definitely cannot say it. Actually, it's January 9th.
Yeah, we're basically in 2025 by now.
Yeah, you can't even say hello right now.
Chris, even the S&Ps are down $28. They haven't moved. What do you think about this whole thing going on? CPI later this week. I know you like that kind of stuff. What are we talking about today?
Oh, well, we could talk about the calendar this week. It's actually pretty barren. You do have CPI on Thursday, and then ultimately bank earnings kick off this earnings season on Friday. CPI, of course, is perhaps this last gasp of what's been a little bit of a rebound in inflation print since the middle of last year. June was the low for inflation, and then you do see a steady rebound. But a lot of that was due to base effects in the data because the individual components like energy, for example, continue to peel back. Now that we're getting through the 2023 data set, once we roll over into January, February, March, inflation readings are going to come down very, very quickly, which may actually help substantiate some of this market pricing for all these Fed rate cuts, which kind of got away from us at the end of December when everyone was off on vacation. Market was pricing in, 7 cuts in 2024? That doesn't make a whole ton of sense given the Fed's calendar, what have you. But the past week or so, a weaker start to the year, which I suppose is a good place to begin this conversation. And let me explain what happens when the Santa Claus rally fails, which I know Josh has been joking with people that, of course, this is something Chris would bring up because it is an outlier statistical tendency that's worth paying attention to. But this year, the Santa Claus rally did fail. It didn't produce that outsized return, gains north of 1.2, 1.4%, depending upon the time frame you look at. In the final 5 days of the year, the first two of the new one, S&P lost 1.05% during that window. So the question is, what happens in January thereafter? Historically speaking, it hasn't been good. 60% of the time, January is closed lower when the Santa Claus rally fails, an average loss of 0.3%, median loss of 1.8%. And that actually comports with what is typically a not so great start to any calendar year. January is not a fantastic month for stocks. It's minorly positive. It ranks 7th in terms of best performance when you look back over the past 5 or 10 years. When you go back even longer, it ranks right around 8th if you go back to 1950. So it's not really an outstanding month. February is the second weakest month of the year. So knowing that we have this setup where the market's overpriced these Fed rate cuts, knowing that we have very, very low volatility here, it seems like it's a little bit complacent and it could be a choppy few days, few weeks here ahead. Certainly, yesterday's move was quite impressive. The rally that we see in the NASDAQ and the S&P comes alongside a push lower in vol, and that's obviously something that typically goes hand in hand. But as far as I'm concerned, traders should be expecting a choppy month here. I think there are going to be plenty of range trading opportunities abound if it's something like in crude oil. If it's something like in gold right now, which continues to consolidate, both these metals and energy ultimately should be the place that traders are looking here, unless they're looking at the Russell, of course, which has the most vol of any equity index to kick off 2024.
Yeah, and volatility in the Russell continues to uptick a little bit too. IV rank of 37, as you said, is strongest or the best. Even the S&Ps, the IV rank there is 10. So yeah, it does have one of the better IV ranks. If you're looking to put money to work in the equity markets to sell premium, maybe that's the place to go.
So my take on this, Chris, I think that I disagree with the whole Santa Claus thing because, yeah, the last week of the year we didn't go up, big deal.
20% before that.
The rally, yeah, there was from November 1st to the end of December, we rallied like an insane amount. So everybody just tried to jump on it early, and then they ran out of steam.
But that's not the Santa Claus rally.
No, I understand. It is a Santa Claus rally. They
not to the letter of the law, like my friend has pointed out to me.
They just beat it. They just jumped it. That's all it is. Everybody tried to get on board before, and everybody front run it. They front run it. That's all they did. Front ran it, and so we did have a massive Santa Claus rally. Now. This is just so rather than think about this in terms of like, that was a sell-off or anything else. I think this is just actually a really normal. We had a massive rally. We had a normal pullback. It's nothing. I mean,
I wouldn't even consider this a pullback.
I mean, we've had 5 days from we've had a sell-off from the last day of 2023, to basically yesterday when we were up 60 handles. That's it. That's it. I don't consider that anything other than, hey, we got so overbought. It was so ridiculous, that now we're coming back to reality. I think that's really all it is.
I think that's actually a very fair assessment to provide an additional contour to this conversation. We gained over 14% in the S&P 500, about 14.6% in November and December. That's an exceptionally strong a 2-month return. In fact, you haven't seen a 2-month return like that much in history. Only 12 times it's occurred where the S&P's gained more than 14% in a 2-month period. And so what happens to the S&P 500, let's just say a year later? It's up 20%. 91% of the time that you see a rally of that degree in 2 months, you see the market extend higher by 20% on average over the next year. The median return is like 20.8%. So just because there's some short-term difficulty in this market, which January, perhaps you may not believe the Santa Claus rally stats, but let's just say it's tough sledding here the next month or two. That doesn't preclude that this is a market could rally, later on in this year. And quite frankly, if one of the catalysts has been these shifting Fed rate cut odds, then if they are going to come off the table because 7 cuts this year, I mean, guys, we're not going to get a move in January. There are 8 meetings a year. That means we have 7 left on the calendar for 2024. The Fed's cutting every single meeting. Throw in the wrench of a presidential election, and the Fed really does not like to move on policy in the 2 meetings prior to the election, the September, November gatherings. That really only leaves 5 meetings this year. So if you're getting 175 basis points worth of rate cuts in those 5 meetings, something bad's probably happening to the economy. And during the rate cutting cycle itself, stocks tend to do poorly. So, kind of be careful what you wish for. We can get rid of the excess in the rates pricing. Markets can resume their rally, perhaps, let's say, in March. But I think you have a choppy few weeks here ahead of us if recent history has been any sort of roadmap.
Yeah, I don't disagree. I think you have a choppy few weeks ahead. I think that's exactly.
And trading is a function of both price and time, right? We say this often, but you can see a market lose its overbought conditions. We've gone up too fast, too quickly, simply by trading sideways for a little while. You can get rid of those excesses in the market because you don't need to see a correction in price, just a breather, if you will.
Sure. All right. What else you got?
Well, a lot's been going on in this oil market the last few days. Yesterday, Saudi Arabia announced that they would be cutting the price of their light Arab crude that goes on sale to Asia. Asia, roughly speaking, is about 37% of global demand for oil. And so you say, well, why is Saudi Arabia cutting prices to Asia? The demand must not be there. If you have a good or service to sell, you don't sell it at a lower cost unless you're not meeting the demand at the previous price level. And that obviously has a spillover effect where yields move to the downside. Stocks then take the cue. They start trading up higher yesterday. Today's kind of the reverse of that price action with oil bouncing back. Yields are ticking higher. Inflation expectations have moved up. Stocks are coming off a little bit. I can understand those things. But the energy market still has perhaps the most vol consistently on the board right now. Ivy ranks in the high 40s for crude oil contracts, as it were. And even though you saw a big decline yesterday, this is a market that's really not digging too much deeper to the downside right now. I know we've been talking about this for the past few weeks, minus the time that we were on vacation, of course. But throughout November and December, one of the plays that we had discussed here was continuing to look to sell puts in crude oil, put spreads, maybe even iron condors to cap the risk a bit more. And that seems like a very viable strategy still in the short term. I don't think people should be scared away by the high vol. They should be welcoming it, particularly if you look to equities. There's not a lot going on there. Of course, there's idiosyncratic risk in certain individual names, like a Boeing, for example, this week has a ton of IVR. But when you think about what's happening in oil, it's been structurally there, and there's little reason to think that volatility is going to dissipate in the near term. So it's a prime place to look for trading opportunities still here at the start of 2024.
Yeah, I have my only issue with crude oil is that it's a one-trick pony in the sense that once you have positions on in there, and it has been moving around a lot, and it's been rewarding, and it's been a good trade, but it is a one-dimensional underlying, and so once you have a position on there, there's not much else you can do. Like, you can't really get too bold. I have a couple positions on in CL, and that's about it. What are you going to do? Yeah.
And USO is kind of a deadish.
Yeah,
product,
USO
too.
is fair at best, and
And when you get to the Exxon Mobil's or
or the CVXs, I just think my only issue with crude oil is that is, again, it's just a one-trick pony. You put a position on, and you're done. Like, the nice thing about the S&Ps is that there's literally hundreds of choices in the equity markets, but in the crude oil markets, you're pretty much tied down to, 1, 2, 3 underlyings, and I mean, I love the fact that you can fill anything one tick around mid-price. It's got all the price discovery built in. It still moves around a lot. It's got high implied volatility, but that's it. I'm done. I'm in. I made my bed. We're short premium in there, and we're just gonna, ride it. The strangles we adjust all day long, but then the iron condors we just leave. So far, so good.
So far, so good. Natural gas is obviously on a ride because apparently the markets remember that winter still arrives at some point in time. Polar vortex apparently making its way into the lower 50 or lower 48, I should say, this week. So natural gas prices have been on a bit of a tear. I know that you guys have been looking, I think, at the long side the last time we spoke in December, now up to about $3, 13.5 cents. That's a nice little 5% pop here today. Volatility isn't super high, though, in natural gas, which I know that people look at the IV index and say, wow, that's really ripe. But the IVRs, they really haven't eclipsed, like, say, the 40 level yet. I think I saw it at 36.3 earlier today. Mm-hmm. So, natural gas is still a very tricky play. I just prefer to, play in the crude oil end of the pool and energy as opposed to natural gas right now.
I agree. If all things were equal, I'd prefer crude oil, too. Natural gas, I have positions in there as well. It's very tough. I feel like I'm always playing defense, but, welcome to my life.
Markets are okay in that gas, but it's a very big
They are okay during trading hours. Mm-hmm. Like, they're not very good, like pre and post market, and they get ugly, and you're still giving up on average, verticals, you're giving up 1 tick, but anything more complex than that, if you're doing strangle stuff, you're giving up 2 ticks, sometimes 3 ticks. Mm-hmm. So it's a little less liquid. What else you got?
I wanted to pick your brains on what's going on with this Bitcoin ETF, because this seems to be the mother of the buy the rumor, sell the news type of event.
I think that's the way we've been approaching it. It's a buy the rumor, sell the news.
I can't for the life of me wrap my head around what the audience here is for these ETFs. Because quite frankly, if you've wanted to get exposure to crypto, you can do so in a number of ways. You can go to exchange, you could buy it, put it on a cold wallet, you could have it somewhere like Tasty Crypto. It's pretty accessible for everyone. Hell, I could go on PayPal right now and buy some crypto if I wanted to. The point I'm getting at is that the ETFs are really vehicles for money managers. No one who's going to be trading crypto per se really would do it through the ETF and incur all those additional fees. And the lack of liquidity as well. There's going to be a tracking error, so to speak, as a result of some of these fees. So I guess what I'm thinking about this is like, who uses the ETFs? Is it going to be a money manager? What kind of fund manager is going to allocate capital?
No. Everybody. So Chris Vecchio, who wants to trade Bitcoin, is going to use the ETFs. Same with Tom, same with Tony, same with anybody at an online brokerage firm. So what the SEC has done very effectively, because they want to get rid of cash and OTC crypto because they really can't regulate it. What they've done is they're effectively forcing everybody into. There's no reason. Nobody wants to go to PayPal and store it in some third-party wallet. That is absolutely ridiculous. Like, you want your cash, and you want your cash accessible, and you want to be able to be long or short something. You want to be able to buy it on margin. You want all the advantages of the listed and centrally cleared equity markets with none of the risk. I mean, why do you want to risk in some wallet you don't know, and you got to worry about your password, or what you got to worry about? You can't leverage the money, you can't touch the money, you can't really use it. The whole thing's a pain in the butt. The reason we're all going to use the Bitcoin ETFs when we want to trade Bitcoin is because now we've truly commoditized Bitcoin. It'll be a penny-wide market. The ETFs, penny-wide market. They've got so much competition for fees that the fees are only going to be down to, looks like, between 25 and 30 basis points. And you have leverage. So you can be long, short, blah, blah, blah. So it's a perfect way to trade Bitcoin. Now, I don't like it because essentially by doing this, they've we've got rid of the altcoins, which to me is kind of at the core of this whole technology play, is a lot of what these altcoins bring to the marketplace, like Solana or Cardano and all these other things that we can no longer offer to our customers, which sucks. And for that reason, like, that's what I hate about what the SEC did. But as far as moving as far as taking it essentially off chain and moving it into, a centrally cleared brokerage firm, it's a huge benefit for all customers to have that option. Like, nobody wants to own, right now, if you buy Bitcoin on Tasty, which you can do in the spot market, the money's dead. It moves out of your account. You can't use it for leverage for anything else. It's essentially dead money. It sits there, waiting for what your next move in Bitcoin.
Fully margined also, right? Is it?
Not fully margined now. There's no margin. So
that's what I meant. You have to pay for it in full.
It's you have to pay for it in full. You can't borrow against it. You can't count it against your other positions. Like everything. It sucks. So what you're going to be able to do now is you're going to be able to buy some Bitcoin, diversify your portfolio, use it as your net liquidating value. So everything about it is great, except that by doing this, they essentially took away a part of the marketplace that a lot of us loved, which is all the different little small technology plays, which I think are very valuable to the whole asset class. Like, I want to own Solana. I want to own Polkadot. I want to own Cardano. I don't want to only own Bitcoin and Litecoin or ETH. So I think that's the real issue here. Having these ETFs, and plus there's too many ETFs, plus there's not that big a marketplace for all this stuff. So I think it is totally a buy the rumor, sell the news type thing. I think that this is just, there's a 100% chance they're going to be approved, and that's it. But it's good for us. It's not, the alternative is you were not going to take your money and buy Bitcoin at PayPal. I was not going to take my money and do something at Coinbase. Okay, I'm not doing it. So the alternative here is that now I have a lot more options for Bitcoin. That's cool.
I suppose more options are better. I think about the fund manager at the end of the day, who's going to have to allocate for his clients, who's going to look at the risk profile of Bitcoin and say, like, well, unless this is a self-directed investment, no fund manager is going to allocate anyone's retirement funds.
I disagree. The statistics do not, they don't support that, Chris. They basically say that, Bitcoin adds very little downside risk. Historically, because it's only been up, right? Nobody that's ever bought digital assets in the case of Bitcoin or ETH over time is down money. They're up a lot of money. People that have bought and hold are up a lot of money, or bought and held are up a lot of money. So the reality of Bitcoin and ETH is that if you've added that to your portfolio, even 1 or 2% of your portfolio, it's been a huge alpha boost, and it's really helped your performance. And so far, looking back at the last 12 years, there's no portfolio scenario where owning digital assets hasn't helped you. So
that's 100% true. And I've read the studies where it shows the optimal, allocation of crypto is somewhere in the neighborhood of 2 to 4%. For your given portfolio. Yeah. But I guess my point I'm getting at is I think the people out there who have interest in crypto that want to take that risk, they've already jumped in with 2 feet. This is not exactly a baby industry. Yeah, it's in the grand scheme of things, it's only like a decade plus old, but in reality, this is a pretty well-known thing. There are countries that are advertising their support, putting it on their balance sheets, like in Ecuador. And so I don't think this is something that's coming out of the woodwork, so to speak. It's not like a coming out party for Bitcoin. It's pretty well known.
Yeah.
Crypto.com, we have the FTX ads with Tom Brady and Larry David. I mean, it's entered the zeitgeist already. So I don't know what this is more than a marketing push that kind of vindicates, hey, this is a legitimate financial asset that people can trade.
I don't disagree with you. It is a marketing push, but it really is a marketing push. It's a way to validate digital assets in a form that the regulators can live with. That's all it is. They basically said, okay, everybody will essentially we're going to bless this asset class as long as it's in the form of a traditional centrally cleared
as long as it's under our regime.
Yeah, exactly. And so, you know, that's the bad part of it, because the beauty of Bitcoin, the beauty of digital assets is the technology that's behind them, and the SEC doesn't see it that way. So we're basically eliminating, you know, all these brilliant technologists in return for, you know, something they feel like is more appropriate for the average investor.
Fair enough.
Awesome. Let's take a quick 90-second break and come back. We got more Tasty Live. Thank you, Chris. We got a
Thanks, Chris.
market measure next.